Wall Street thinks 2026 could be a 15% year for stocks. And the setup sounds perfect. AI boosts earnings, and Fed cuts boost valuations. But there's a catch. This entire bull case hinges on one fragile variable. If it breaks, the same perfect storm can turn into a nasty correction. In this video, I'll show you the 3 bullish pillars pushing the market up, and the 3 tripwires that can flip it fast. And by the end, you'll know what to watch month to month so you're not guessing in 2026. Pillar 1. AI isn't a story anymore. It's a spending cycle. And the number to watch is capex. The AI boom has a hidden weak point, capex. But for now, that spending is the engine pulling the market forward. Projections for AI-related capital spending are set to hit an incredible $571 billion in 2026. Here's the simplest way to see the AI trade. Step 1 is the brains, the chips and data centers. This is still NVIDIA's world, with demand locked in by multi-year investment plans from their biggest customers. Step 2 is the brawn, the power and cooling. Here's the part people miss. These AI data centers are incredibly power hungry. This creates a massive opportunity for companies that provide the essential infrastructure. Take a company like Vertiv, which specializes in the power and thermal management systems needed to keep these data centers from overheating. The demand is so intense that analysts are forecasting over 30% annual earnings per share growth for the company for the next few years. So here's the bottom line so far. AI spending is real, it's massive, and for now, it's lifting earnings across the market. Then, step 3, every other industry starts to adopt the tech, squeezing more output per worker. Companies like Adobe and Salesforce are weaving AI into their software, while industrial giants use it to fix their supply chains. This is where the AI boom spreads from a few tech giants to the entire economy. It points to a genuine productivity-fueled expansion, which directly fuels corporate earnings. And earnings are the lifeblood of stock prices. Analysts widely expect double-digit earnings growth for S&P 500 companies in 2026, way above the historical average. If companies deliver, it provides a solid foundation for stock prices to keep climbing. Next up, the second pillar, a friendly Federal Reserve. After a long fight with inflation, the Fed is changing course, making a final quarter-point cut in December 2025. So what does this mean for the S&P? Here's the scoreboard for 2026. Wall Street is pricing in about 2, maybe 3 rate cuts. The Fed, however, is hinting at just 1. If inflation behaves and Wall Street is right, stocks get a powerful booster. Lower interest rates act like rocket fuel for a few reasons. 1, it makes it cheaper for companies to borrow and invest in growth. 2, it pushes investors out of safe assets like bonds and into riskier stocks, a classic effect known as TINA. There is no alternative. 3, it just makes stock valuations look better on paper. When the rate used to discount future profits falls, the present value of those profits goes up. It's a mathematical excuse for higher prices. After years of the Fed working against the market, having it work with the market is a profound change. So here's the fork in the road. If cuts come faster than the Fed admits, 2026 looks strong. If they don't, stocks lose their biggest tailwind. And that brings us to the third pillar. This party is about to get a lot bigger. For much of the bull market, the gains were dangerously concentrated in the Magnificent 7 stocks. That's why the equal-weighted S&P 500 has lagged the normal index so much. But now, leadership is finally set to expand in 2026, the sign of a healthy, sustainable bull market. While tech will likely still grow fastest, earnings growth is expected to speed up in other sectors like industrials, materials, and utilities. Quick question, do you think we get 1 cut or 3 cuts in 2026? Drop 1 or 3 in the comments. This rotation is helped by the Fed. Lower rates are especially good for cyclical, rate-sensitive parts of the market like small caps and real estate. But it's also because the AI boom itself is broadening. The first winners were the chip designers. Now the adopters are seeing the benefits. A manufacturing company using AI to predict machine repairs. A healthcare firm using it to find new drugs. This is the second wave. It's this expansion of leadership that makes the case for a 15% bull run so compelling. Okay, the bull case sounds good, but what could go wrong? Now here's the uncomfortable part. The bull case only works if nothing reignites inflation. The biggest risk is that inflation proves stickier than expected. If inflation gets stuck above 3%, the 2026 bull run narrative breaks because the Fed can't cut the way the market expects. The whole bull case hinges on inflation falling back to the Fed's 2% target, but it hasn't been there for about 5 years. There's one chart that tells you if the 15% bull run is still alive, the inflation rate. If it stays above 3%, the market's dream of multiple rate cuts evaporates. A few things could keep it high. A still tight labor market could keep wage growth and services inflation hot. And strong economic growth, partly from the AI boom itself, can be inflationary. This puts the Fed in a terrible spot. Instead of cutting, the Fed might have to stay on hold or even hike again. That would be a massive shock, crushing the high valuations holding up the market. This is the number one risk. The second tripwire is the risk that the AI boom is an unsustainable bubble. If AI capex slows, even slightly, these high valuations won't get patience. They'll get punished. The incredible run in AI stocks has drawn comparisons to the dot-com bubble. While today's AI leaders are profitable giants, the market is pricing in years of flawless, rapid growth. Any disappointment could trigger a sharp correction. And here's the weak point we talked about: the sheer cost of AI. At some point, investors will demand to see a clear return on the $500 billion spending spree. If making money from AI takes too long, those companies could pull back on spending. Any sign of a capex slowdown would send a shockwave through the semiconductor and infrastructure stocks that have led the market up. Plus, competition is heating up. NVIDIA is dominant, but rivals like AMD and a host of others are fighting for a piece of the pie. That competition could eventually erode the sky-high profit margins that have justified today's premium prices. Because the market is so concentrated, a big downturn in a few tech stocks would be almost impossible for the rest of the market to ignore. The final risk is the one markets never price correctly: an external shock that forces everything else to break. If a geopolitical shock spikes energy prices, it hits inflation, hits the Fed, and hits stocks fast. And there's one date in 2026 the market will care about more than earnings: May 2026. That's when Fed Chair Jerome Powell's term is up. A new chair could bring a whole new philosophy, throwing another dose of unpredictability into the mix. On the home front, we have to watch the American consumer. Consumer spending is the bedrock of the U.S. economy, and it's the fastest thing to crack when confidence breaks. While not a front-page issue, some analysts also warn about rising default risks in the bond market. The market's rosy forecast has priced in a lot of good news, making it more vulnerable to a single negative surprise that could shatter the bull case. So where does that leave us? We've walked through a powerful bull case for 2026, built on the twin engines of an AI productivity boom and a friendly Fed. The chance of the rally spreading makes the idea of a 15% or even higher market gain feel credible. However, we've also seen that this road is full of potholes. Stubborn inflation could sideline the Fed, the market's AI party could be vulnerable to a painful hangover, and the threat of an out-of-the-blue shock is always lurking. The key takeaway is that 2026 is shaping up to be a real tug-of-war. It's the AI supercycle versus everything else that could possibly go wrong. Ultimately, whether the bulls or the bears win will probably come down to two things: corporate earnings and Fed policy. If companies can really deliver on the promise of AI and post the double-digit earnings growth that analysts are calling for, it will provide a strong fundamental floor for stock prices. And if inflation plays nice, allowing the Fed to move ahead with rate cuts, that will provide the liquidity to keep the rally going. This isn't a time for blind optimism, but it's not a time for knee-jerk pessimism either. It's a time for careful thinking and a balanced view. The opportunities are huge, but the risks are just as real. What do you think? Do you think the S&P breaks new highs in 2026? Or does it stall below 2024 levels? Drop your call below. And if you found this analysis helpful, make sure to subscribe and hit that notification bell so you don't miss our next breakdown of the forces shaping these markets. 2026 is going to force investors to choose sides, and I'll be tracking it here every step of the way.